Step 1. Understanding the internal control process. Recall, it is required by GAS that the auditor understand the internal control process. Auditors use their knowledge from previous audits and knowledge of the client's industry to assist them in identifying the important control areas. Understanding the internal controls requires the auditor to determine if the necessary controls have been placed in operation, if the client is using certain controls, and if the client has designed the necessary controls to prevent and detect material financial statement misstatements on a timely basis. It is very important to see that during the understanding phase of the internal control process, the auditor is not conducting tests of controls to determine if the controls are operating effectively. The understanding phase is more of an information gathering step. What must an auditor understand about the client's control process? Auditors must understand 5 internal control components. Do you remember what they are? The control environment, risk assessment, control activities, the information and communication process, and the control monitoring process. Let's define each of these control components. The control environment sets the tone and the foundation that provides the discipline and structure for the control process. There are 7 control environment factors, and yes, CPA candidates, you should know these 7 control environment factors as follows. Human resource policies and procedures. This is the process of evaluating, counseling, retaining, promoting, and hiring the most qualified people. The theory here is the more qualified the people are, the better they can perform. A quality performance leads to a more stronger control process. Assignment of authority and responsibility. Appropriate business practices to assign and carry out responsibilities. Management's philosophy and operating style. When management establishes a conscientious attitude toward accounting and information processing functions, the better chance management has of meeting its objectives and of maintaining a strong control environment. Auditors become concerned when management does not care about a positive control environment. Active participation by an audit committee, board of directors, and internal audit staff. Does the audit committee, board of directors, and internal audit staff act objectively? These 3 groups should be free to carry out their duties as needed and raise difficult questions as needed. When restrictions are placed upon their actions, the internal control process is compromised. A decentralized organizational structure. The more decentralized the corporate structure, the greater the control. Auditors become concerned when the corporate organization chart points to one person who has final decision-making authority. A commitment to competence. Management must possess the necessary knowledge and skills to carry out their tasks. Each job should be clearly defined in a written job description. Integrity and ethical values should be held in high regard. Management should remove incentives that would prompt dishonesty. Establish a code of ethical conduct and follow that code to serve as a role model for ethical behavior. Candidates should know the above 7 control environment factors, and remember the auditor must document the understanding of how the control environment affects the audit. For example, if management decides they will limit the audit committee and board of director involvement in the control process, and they do not hire competent personnel, then it is clear that the auditor should assess the control risk high for some transaction areas. Auditors should also remember to consider the true substance of the controls rather than just the form. Management may show controls on paper, the form, but when it comes to actually acting upon the controls, the substance, they are weak. The second control component that the auditor must understand is the client's risk assessment. Stay awake here. In this situation, the auditor is not assessing the control risk. The auditor is taking time to understand how the client, management, assesses their risk situation. The auditor, of course, is most interested in the risks relevant to the financial reporting objectives and how management decides to address those risks. As always, the auditor's primary concern is whether or not the financial statements contain material misstatements. As a result, the auditor is hoping that management takes the time to seriously evaluate and assess the risks relevant to the preparation of the financial statements. When management takes the time to identify, analyze, and manage the risks relevant to the financial statement preparation, there is hope that the control process might be effective. But be careful here. Remember that during the understanding process, the auditor is merely looking to see if the client is using the controls, placed them in operation, and has designed controls. Do not accept an answer that indicates the auditor is testing control effectiveness. Control effectiveness can only be performed by conducting tests of controls. Control activities, the third internal control component, are defined as the policies and procedures that help ensure that management's directives are carried out. The control activities are the necessary actions taken to address the risks that could keep the entity from meeting their objectives. There are 4 categories of control activities. 1. Performance reviews, such as comparing actual financial results to budgets or forecasts. 2. Information processing. Controls are needed to check the accuracy, completeness, and authorization of the financial transactions. Recall from the Auditing with Technology CD that there are 2 kinds of controls over computerized processing: general and application controls. Both types of controls must be in place for an entity to meet their objectives. 3. Physical controls. This encompasses the safeguarding of assets, records, and documents. 4. The final control activity is that of segregation of duties. Assigning different people the activities of custody, authorization, and recording will hopefully reduce the possibility of one person to be in a position to both perpetrate and conceal fraud or illegal acts. The fourth internal control component is information and communication. The information system that is relevant to the financial reporting objectives includes the accounting system. The information system encompasses the entity's ability to gather, summarize, process, record, and report transactions. The communication aspect of internal control pertains to the entity's methods of communicating financial reporting roles, responsibilities, and significant reporting matters. Keep in mind that communication can be verbal or through the actions of the management team. However, written communication through the use of policy and procedure manuals and memos is an excellent communication means. Auditors are no longer allowed to audit around the client's computer system. They must understand the client's computerized processes for all major systems.